Well, from the Land Grant University here in Urbana-Champaign, Illinois, this is the 2020 Illinois Farm Economics Summit. I'm University of Illinois Extension's Todd Gleason. Thank you for being with us for the day. We appreciate you being on hand. We have a couple of folks that are going to help make a presentation in this first in our IFAS webinar series. Again, there are 5 of them. If you are signing up later, watching this after the fact and or not to the 15th of December, you still have time to get signed up and registered, and you can catch us live on a Tuesday or a Friday at 11 o'clock. Today, the 2021 Market Outlook for Corn and Soybeans, presented by Scott Irwin and Joe Jansen. They're from right here in Urbana-Champaign on campus, an agricultural economist in the College of ACES and the Department of ACE. And gentlemen, thank you so much for being with us today. Scott, I think you'll begin our presentations.
I will. Thank you so much, Todd. And I'm really excited to be here to launch our 2020 virtual IFAS meetings. I look forward to meeting many of you in person next year. And I also want to thank Joe Jansen for joining me today. Many of you may not know Joe. He's a new faculty member here in the Department of ACE and comes to us via Kansas State and Montana State. And I think we've got a really good presentation today. And I just want to get right into it. So Joe, if you'll go to the first slide. All right, basically, just going to start off with a little bit of where we've been in terms of price action. Man, what a ride the last 3 months from what looked like a very dismal price outlook just 3 months ago. We're now sitting at some of the highest prices of the last 6 years. Here's the March 2021 corn futures price chart. It's basically up about $1 since mid-August, or 30%. Here's March soybeans, and we can see that that's up $3 per bushel, or a little bit more than corn. That's up about 35%. So we've gone from the low 3s on corn and low 8s to mid 8s on soybeans to near $11 cash and $4 cash corn. So a remarkable turnaround in the grain market situation. And so what Joe and I are going to do today is basically try to address 2 questions. How did this happen? And where do we go from here? In other words, the answer of how did this happen is going to help us understand where do we go from here. So, number 1 factor, next slide, Joe, is exports. This chart shows the weekly total export commitments for corn. And it's important to understand what's being plotted here. It's actual exports up to cumulative up to that date, plus outstanding sales at that point in time. And what you see, the blue line is the total export commitments for corn up to last week, which is the latest data that's available. And we're at about 1.45 billion bushels of total export commitments for corn right now. And we can see that that's a huge increase over a year ago, or our 5-year average. In fact, exports right now, total export commitments, are up basically 900 million bushels over last year. And roughly 50% of that increase is due to increased exports to China. That's the story. And we can see that we are, substantially above the pace that we would normally see for corn export commitments at this time of year. But we'll want to keep this in mind as we move forward. The USDA has a very aggressive total export forecast that's shown in that magenta line at the top of 2.65 billion bushels for the 2020-21 marketing year. We've got a great start on that, but still have to have a very aggressive shipments and export level to get there. And we'll talk about that a little bit in a few minutes. Here's, the place where export sales have been truly red hot in soybeans, the same chart that I just showed you for corn. And we see that we're already up to just slightly more than 1.9 billion bushels of total export commitments for soybeans as of the latest data last week. That's basically a billion bushels higher than last year. And once again, the number one factor is China. 75% of that increase of a billion bushels over last year for soybean export commitments are extremely impressive. We normally expect exports to tail off, particularly in the second half of the marketing year as the South American supplies become available. But we are, not very far from the 2.2 billion bushel forecast that the USDA currently is carrying for the 2020-21 marketing year. In fact, that 1908 is already 87% of the 2200 WASDE forecast for soybean exports in the current marketing year. So even if export commitments tail off dramatically, I think that there's some prospect for exports maybe even being a bit higher than that 2200 figure for soybeans. So we've had tremendous action on the demand side of the grain and oilseed markets, mainly represented by export sales to China. But we've also had some action on the supply side. Here in the US, I think probably everybody knows, it turned darn dry through the heart of the I states late in the 2020 growing season. This drought monitor for August 25th shows where those trouble spots were in terms of dryness. And then in mid-August came something that was truly unprecedented. A derecho swept through Iowa and northern Illinois and all the way into Indiana. And the combination of the dry weather and the derecho, it's easy to kind of lose track of this in all of the hoopla about export sales to China. That combination of dry weather and the wind damage dropped the U.S. corn production estimate from the USDA between August and November by almost 800 million bushels for corn and around 250 million bushels for soybeans. So that's a cumulative drop of almost 5 to 6% on the supply side. So that's what's been going on the supply side in the US. Now let's turn to South America. The next chart shows a measure of the El Nino, La Nina oscillation in the Pacific. And what this chart shows, you look clear to the far right, a -1 or greater reading is a strong La Nina, and that's where we have been heading in the last few months in South America, and that has some correlation to dry growing season weather in South America. And it has been dry in South America. This is a 30-day percent of normal precipitation ending on November 27th. And you can see, particularly in northern Argentina Uruguay, southern Brazil, it has been very dry, although they've gotten some rains in recent days, and also stretching all the way up in a little bit farther north into the Mato Grosso soybean and corn producing areas, but it's not been as severe there. So you have a La Nina and it's been dry. So you put all that together and the demand and the supply side, and you have some pretty explosive conditions for prices. So let's put that in a little bit more perspective here. What this chart shows the U.S. corn supply and demand balance sheet, and I've got some 18, 19, 19, 20, and then I have the 2021 May WASDE supply and use table for corn, the November, and then my own personal balance sheet that I've come up with. And what we see here is basically what I can talk about, some things I really want to point out. You can see that production between May and November WASDE for corn dropped almost 1.5 billion bushels, with usage flat, but that being reflective of a decline in feed usage and ethanol usage, but a huge increase in projected exports, so that we have ending stocks from the May to the November WASDE dropping from 3318 to 1702, or a stocks to use ratio of 22.4% to 11.5%, and the USDA projected price going from $3.20 to $4. Now, I've made a couple small adjustments in my own personal balance table for the current marketing year. I've got feed and residual going down another 50 million bushels based on, I think, kind of a plateauing of livestock numbers and feed getting more expensive. And I've got a pretty healthy increase in ethanol usage. I think with the vaccines and the news that we've gotten, I think that we will see, particularly by March, April, a pretty substantial reopening of the and loosening of the restrictions in the economy. And particularly when we get to summer, I think we're going to be flat out everybody wanting to drive. So I'm going to give us a little bit more ethanol usage, and that gives us a small drop in the ending stocks down to 1672 and the same price as the USDA. So that's the old crop on corn. All right, let's look at soybeans now. Okay, the same kind of chart for soybeans. Really interesting situation on the old crop. What we see is that quite interesting on soybeans between the May and the November WASDE, production actually increased slightly, even though it dropped from August to November. That's mainly based on not quite as optimistic yield projections by the yield projections when we got to August were substantially higher than they were in May. But again, the big story is continued increase on the use side, particularly on the export side, but the combination results in an ending stocks of 190 million bushels, which is down to 4.2%. That's among the lowest ending stocks to use ratios that we have ever seen, and that not surprising in that situation that we've gone from a estimated price in May of 820 to 1040 now. I'm going to use the exact same balance sheet for my own personal forecast for 2021 as the USDA has currently in November, except I think that the evidence is that we're going to end up with a higher price than the USDA is currently carrying. They're using 1040. I think it's going to be something closer to that 1080, 1090. I'd list 1090 here. So very strong corn and soybean prices in 2021. So of course, that's kind of where we've been recently, how we got to the very high prices. Of course, what everybody really wants to know now is, are we going to stay here? And so I'm going to start with kind of a very early look at supply and demand balance tables for the 2021-22 marketing year. And this starts with this chart. This is one of my favorite charts to think about the supply side for corn and soybeans. This chart shows the composition of total crop acreage in the U.S. on an annual basis going back to 2008 with my forecast for 2021. The total crop pie, as I like to put it, consists of the area that we actually plant to principal crops, the amount that's in CRP, and then the amount that we don't get planted in terms of prevented plant. And if you look for 2019 and even 2020, the prevent plant was a major story in terms of where we ended up in terms of principal crop acreage. So as we look to 2021, I'm forecasting that we're going to begin edging up in total crop acreage in the U.S. We've been around 344 million. I've got us penciled in for an additional 2 million acres based on the much higher prices. And I'm also forecasting a more normal historical average for prevent plant. Of course, that can change based on weather conditions. The end result, though, is look at that green bar for 2021. I'm looking for about an 8 million acre increase in total principal crop acreage as we go from 2020 to 2021, almost to 320 million acres. So we're going to have a large acreage base as we head into the 2020 planting season. Now, what we're interested in, next chart, please, is how is that acreage base going to be allocated, particularly to corn and soybeans, which is what our interest is here. And we have really strong incentives for planting more soybeans. The market is screaming, basically, that we need more soybean acres next year in the U.S. And the last time that we had this high of a ratio of a new crop soybean to corn prices in 2016 and early 2017, we added 7 million acres of soybeans. And so that's basically what I'm going to be forecasting right now for 2021 planted soybean acres. So if we can go to the next chart. So this is the way that I like to think about corn and soybean planted acreage, is to start with the top line on this chart, which shows total corn and soybean planted acreage. And notice that that's a reasonably stable number that has varied basically from around 179 million to 183 million acres. It was a total of 182.8 in 2020. I'm going to bump that up on the improved incentives for profitability on corn and soybeans, and a bounce back in principal crop acreage to 184 million total for 2021. Admittedly, a pretty high number. Then prevent plant, I'm going to forecast that to be lower than we've seen in the last couple of years. And that means the actual planted acreage total that I'm coming up with is 181.8 million, or 6.6 million acres higher than what we had in 2020. Again, largely due to that prevent plant story last year, which was kind of, I think, underappreciated. And so with that base of 181.8 million acres, if we drop down to soybeans, I'm basically going to project that our intended planted acreage for soybeans will go up by 7 million acres, and then with lower prevent plant acres, we'll have a total increase in soybean planted acres. It's a big one, from 83.1 to 90.8, or 7.7 million acres. And basically, that's what's driving the story. and that means we'll have roughly 91 million acres planted for corn, down about 1.1 million. So based on current incentives, that's what I think the situation looks like for planted acreage of corn and soybeans in 2021. So now I want to finish up looking at what that implies for kind of what I say a first look at 2021-22 U.S. corn supply and use. So with that acreage figure for corn of 90.9 planted for next year, I project area harvested 83.7. I'm using an trend yield of 179 bushels per acre. I expect the USDA will probably come out around a bushel higher than that. At our beginning stocks, projection of 1672 gives us with a production of 14,982 gives us a total supply of 16,679. And the thing to notice is with soybeans in my projections grabbing so many acres, U.S. total supply of corn is not going to be able to go up that much unless we have fantastic weather next summer and we have great yields. That potential, of course, is there. But based on trend yields, that's what the supply situation on corn looks like. And in soybeans, with that huge increase in area planted, I'm using a trend yield next year of 50.5 bushels. But again, what's really interesting, given that beginning stocks are so low, even with our production level of 4540, or just a little over 4.5 billion bushels, our total supply of soybeans, again, it's so important to emphasize, including a projection of an additional 7.7 million acres, basically gets us to the same supply level in 2021-22 that we have in our current marketing year. So a really interesting situation. So I want to just briefly touch on use factors. So when we look at going forward, there's just no way that you can't separate out the demand outlook for grain and oilseeds from what's going to happen with COVID. And we've all seen the announcements about the vaccines. They sure seem to indicate that the worst of the pandemic will be over once the vaccines are widely available. And I think we need to factor that into our outlook. Next slide, please. And the most obvious place where that's going to factor in the corn balance sheet is in ethanol usage, which is directly tied to gasoline usage, since every gallon of gasoline in the U.S. contains at least 10% ethanol for all practical purposes. We've had a swish recovery from the springtime lockdowns, basically planing along or plateauing at about down 10%. Looks like we're going to maintain that probably through the first quarter of 2021. But based on that vaccine news, I think we're going to close that gap really rapidly as we head into the spring. So let me end with a discussion of the use side for corn and soybeans. This is the way I see it going forward. In particular, on the use side for corn, I'm looking for a return basically back to the pre-COVID level for 2021-22. Again, that will be well past when the vaccines arrive. So that's my projection on corn use. Exports, I just don't see any way that we're going to keep up the current pace. So I'm penciling in a very robust, but still pretty high 2,400. Gives us total use of exactly 15 billion bushels and ending stocks of 1679, basically the same for 2021-22 as our current year. And I'm going to drop the price forecast down about 20 cents a bushel, though, as we come off some of these kind of superheated conditions down to 380. Might be a little optimistic on the price, but basically, unless we get somehow huge crops in South America, dramatic change in policies in China or a monster crop next summer in the U.S., we're looking at much higher, somewhat higher prices, even out into the next marketing year than we have been seeing the last 5 years until just 3 months ago. So now let me finish up on soybeans. And on soybeans, you can see that on exports, I'm having those cool off a little bit, crush cooling off a little bit, and giving us total use just a little bit less in the next marketing year than our current marketing year. But given that large size of the demand base for soybeans, again, even increasing soybean acreage over 7 million acres, it's going to be tough to rebuild those soybean stocks very much. And I think that's why, the market has woken up to this situation and why we have such extremely high soybean prices and such strong incentives to plant soybeans. Assuming we don't get a monster crop in South America this year, and that's why the market's so concerned about conditions down there right now, we really can't have anything go wrong with the U.S. crop in 2021, given the size of the demand base, and rebuild stocks very much. So that's the message that I have, and basically that the outlook for corn and soybean prices is certainly improved. I've got it at $10 for 2021. That might be a little aggressive, but the main message is, the downside risk to corn and soybean prices until we get that big acreage next year and big crops in 2021 is not really large. With that, I want to turn it over to Joe, and he's going to give us kind of a longer-term, intermediate to longer-term perspective on China's demand for corn and soybeans.
Right. Thank you, Scott. Yeah, I'm going to focus a little bit more on especially corn imports into China, which is obviously, as Scott showed you, a big part of the current demand pull that's moved prices higher. Thinking both about this marketing year, but especially sort of next marketing year and beyond, what do exports look like, or what do exports of corn and soybeans, especially corn, look like going into China? I think focusing more on corn because there's a little bit more uncertainty and a more variable historical record, as I'll show you. Obviously, we've seen that the current marketing year export sales pace is very strong. Right now, USDA has export sales commitments of around 500 million bushels from the U.S. to China specifically. And the current WASDE forecast is a little bit higher than that in terms of all of China's imports during this current marketing year. However, we've seen some crazy forecasts, things that would have been sort of unthinkable a year ago. The USDA's ag attaché in Beijing recently released a report saying that they expect China to import 22 million metric tons, around a billion bushels of corn in this current marketing year. But it's also important to sort of temper those forecasts. About 5 or 6 years ago, USDA released their long-run projections for Chinese corn import demand, and they showed, sort of this very optimistic projection for Chinese corn imports going up to 22 million metric tons by the year 2023. We didn't get there. Chinese corn imports have been much lower than those long-run projections, and so it's important to maybe temper our expectations a little bit. The current optimism obviously has to do with strong growth in the Chinese economy and the rebuilding of their swine herd following declines due to African swine fever. But the Chinese economy is the one place in the world that's going to be growing this year, growing at about 2% this year, and growing incredibly strongly, forecasts show, for next year about 8%, which is far stronger growth than really any other region of the world. The big question here then is, okay, what's the long-run level of Chinese corn imports? And then how much does is the US likely to play a role in exporting corn to China? So this corn demand is really the result of differences between domestic consumption and production in China. And the the exports that we've seen of soybeans into China from the United States have filled a very large gap. The gap on the right shows that the gap between Chinese consumption and production of soybeans is massive and sustained. It's been there for 20, 25 years. In corn, the story is a lot different. We've really only seen a gap between domestic consumption and production of corn in China in the last 4 or 5 years. Prior to that, China actually built up massive stocks of corn. They had policies, a minimum support price that encouraged corn production, and production actually outstripped demand in that 2010 to 2015 period. Where does this gap come from? In part, it's because of the inability of Chinese corn producers to fill that domestic gap with domestic production. One thing to note is that Chinese corn yields are far lower than the places that it imports corn from, the United States and elsewhere. And in spite of massive growth in ag R&D spending, yield growth in China is about half of what it is in the United States. And so their trend line yields are right around 100 bushels per acre. As shown on this chart, 2020 would be right around 100 bushels an acre versus US trend line yields. We hit sort of that trend line yield approximately this year, about 175 bushels an acre. So the United States does have this long run comparative advantage in corn production. It's not the only country that does, but there's a reason why the Chinese can't meet domestic consumption needs with domestic production. The other way to fill that deficit is through imports. And I want to sort of just compare and contrast really briefly soybean imports, where we've been sending significant quantities of soybeans to China over the last decade, with the case of corn. So China fills its soybean deficit with imports from both South America and the United States. Prior to the US-China trade war, the US was capturing about 30-ish% of annual demand. This graph shows monthly imports into China from the US, Brazil, and other countries. The other countries, almost all of that is going to be Argentina. And we can see that demand from different origins is very seasonal. So the US will export large amounts of soybeans in that post-harvest period, and then once South American production harvest comes in March, April, May, then it's South America really kind of capturing most of and filling most of that deficit. For corn, the story is very different, much more lumpy, and the demand is much newer. So prior to 2015, 16, there were some imports, but again, still really lumpy, just based on periods when Chinese corn users felt the need to pull in cheaper supplies from elsewhere in the world, that domestic production wasn't sufficient. In the last few years, we've seen that Ukraine has captured the lion's share of Chinese corn import demand, the US playing a smaller role until very recently. So this graph shows, again, imports by month, and it's really just in the last few months that the United States has shipped significant quantities of corn to address that domestic deficit. So there is potentially strong and growing demand for Chinese corn imports. And Ukraine has traditionally gotten most of that, but their exports this year are down substantially on declines in yield. So the USDA is projecting that Ukrainian exports will be down about 6.7 million metric tons, or 30% relative to the 2019-2020 marketing year, and the yield decline in Ukraine was about the same. So the United States will have competition in shipping corn to China. On top of that competition, there's a whole host of administrative barriers, what I'll call administrative barriers, that captures a lot to US-China trade in corn. Specifically, there's a tariff rate quota. So the Chinese levy a very high tariff on imports beyond a certain threshold. That threshold is about 7.2 million metric tons. However, it looks like in the current marketing year, that quota may or may not bind for two reasons. One is that quota applies to calendar year imports. So for the 2020 calendar year, we're probably not going to get too much beyond that 7.2 million metric tons. And the Chinese government obviously can waive the quota and bring in imports beyond that 7.2 million metric ton quantity. Looks like both of those things are going to happen, and that's going to enable Chinese corn imports in the current marketing year to be much larger, and they could keep doing that, but there's always the threat that that quota may kick in because of the political preferences of the government in China. The other thing is that the retaliatory tariffs from the trade war remain in place. So during the trade war, we know there was a 25% tariff put on corn and soybeans. That tariff, in part, made it much more preferable for Chinese importers to source their corn from Ukraine. That tariff was waived in March of 2020, but it's still there on the books and kind of floating out in the ether, and could be imposed again in the future. The other sort of very difficult things to incorporate into a forecast are the fact that many of these imports are mediated by state-owned enterprises, that is, companies owned by the Chinese government. And there may be preferences that may influence preferences to source grain, corn and soybeans from particular countries or deal with particular companies. So recently, large grain trading companies, the ABCDs, ADM, Bunge, Cargill, and Dreyfus signed, and China's own state-owned grain trader, COFCO, signed an agreement with Sinograin, the company that manages state grain reserves in China, to import soybeans from South America. And so again, those sorts of preferential trade deals, not between governments, but between companies, may govern some of this trade. And then there's a whole host of non-tariff barriers, pesticide limits, GMO approvals, things like that could come in and sort of limit the potential for imports. Ultimately, I think the big story here is China is importing a lot of corn because of significant differences between domestic prices in China and prices around the world. We saw prices begin to rally back in early 2020 in terms of domestic prices in China, and a few months later, that's led to this surge in exports and increases in prices, export prices in the U.S. and elsewhere in our major sort of corn exporting competitors. China will import grain when it needs grain and when the market dictates. There is, of course, the phase one trade deal, but I would argue that phase one trade deal is not necessarily a mechanism to force prices higher. The causality doesn't necessarily run from the trade deal to prices, but it also runs from prices to the trade deal. So if China has this vague but big goal of increasing imports from the United States in order to meet a phase one trade deal, they can do that by importing many different products. Corn is certainly not the only one. And they're going to look to where does it make best economic sense to import those products. If they just want to export a lot of stuff to the United, or import a lot of stuff from the United States, excuse me, they can do that by importing higher value products and get to that phase one trade deal dollar amount more quickly. But I think in this case, it makes economic sense to import corn into China. So to finish up, what I'd like to do is very briefly just sort of look at I'm going to call this a pro forma balance sheet for corn in China based on USDA data from the previous 2 marketing years and their forecast for the current marketing year, and then project that out a little bit further and think about what Chinese corn import demand might look like. The one thing to note is that corn yields in China have been below trend for the last few years. And so part of Chinese corn demand is going to be met by domestic production. And if we assume that we get that corn production in China gets back to something more like a longer run trend, or potentially even grows further as Chinese investments in ag R&D start to pay off, that gap, the gap between production and domestic consumption in China, is going to shrink. In this balance sheet, the domestic deficit, that highlighted row, shrinks by about 4 million metric tons next year. The obvious and big outlier here is what happens with China's corn ending stocks, and we don't have good data on that. We know that the data on China's corn stocks are weak, that corn stocks are a state secret in China. As a starting point, what I do here is just assume that the stocks reduction is a constant percentage of the domestic deficit, so that if 9 out of 22 million metric tons this year is met by a reduction in corn stocks, we do about the same percentage next year. That gets us to corn imports of about 10.5%, or sorry, 10.5, not 10.5%, 10.5 million metric tons, about in the neighborhood of 400 million bushels, 500 million bushels. I think the US gets some portion of that, but not all of it, as Ukraine production likely rebounds and Brazil continues to play a role. Brazil hasn't really been exporting a lot of corn to China, hasn't really been exporting any corn to China to speak of, and that's sort of another potential competitor for the United States. So do we keep exporting 10, 12, 15 million metric tons of corn to China? I don't think that's likely going out beyond the current marketing year. The US really has the corn supplies that the world market needs right now relative to its competition. So with that, I'll pass it over to Todd. We can move to the Q&A portion.
Absolutely. Thank you so much, Joe. Joe Jansen, of course, ag economist here on the Urbana-Champaign campus of the University of Illinois, along with Scott Irwin, also an agricultural economist. We would like to thank all of our FarmDoc sponsors. They include Compeer Financial, Farm Credit, GrowMark, the Illinois Corn Growers, the Illinois Soybean Association, the College of ACES here on campus, and of course the TIAA Center for Farmland Research. That too is part of the Department of ACE in the College of ACES here on campus. A quick note on some of the upcoming seminars. Remember, you're already signed up for all of these, so you'll be getting an email soon. They run Tuesday, Friday, and then the following Tuesday, which is the 15th of December. But this Friday, the 4th day of December at 11 o'clock, Gary Schnittke and Company will present grain farm income outlooks and risk and rental implications. And then we'll move to farm program and crop insurance decisions. That'll be on, if you've got questions, go ahead and put them in the question box. That's in the GoToWebinar boxes. Those are the gray boxes, either on the left side of the page or down at the bottom, depending on what kind of device you are. Scott Irwin and Joe Jansen, the first question that came in is about the Iowa Hawkeyes. We'll play them Saturday. Do you have any?
If these games actually happen, and we know that sometimes that doesn't always.
The better thing to bet on is whether the game actually occurs. How's that for an answer, Todd?
That might be true. That might be the better thing to be betting on. You know, I will take just a moment. My younger brother is a Hawkeye, and I was at the game, and I don't recall what year this was. I think he was in school, but I was not. In Iowa City, where they trounced us 54-9, if I remember the end of that one. It was not a good day. Let's go on to the question. So what percent of the commitments do you think will actually become exports? I believe this was about corn. What, and maybe you could do both for me, please.
Sure. That's a great question. Because the figures I showed were for what we've actually shipped plus what has been committed as sales. And so the question is, you need the sales to ultimately be turned into shipments. And we know that there's always the potential for sales to be canceled. And the market got a little shook a week ago with announcement that I think China was possibly canceling a shipment or two, and I think it was soybean meal. I don't honestly think with the phase 1 trade agreement and the fundamentals that we're seeing that we will see widespread cancellation of corn or soybean shipments by China. Maybe some at the margin, and I will rely on my colleagues at the USDA, at the World Board for the WASDE forecast, that they, have an aggressive 2650 on corn exports. They see the same level of export sales and the need for those to turn into shipments. And I think that that's still a good assumption at this point. We just don't, there's that fear out there in the market that could happen, and it's real, but until we see widespread evidence of that, I'm not terribly concerned about it unless someone else has better information from inside the Chinese government than I do, which I will admit is not that.
I don't have that better information, Scott, but I think that maybe one other piece of information that I think maybe lends credence to what you're saying is if you look at when those export commitments came in, we went into the marketing year back in September with something like 8 million metric tons of export sales to China. So you can think a lot of that corn was contracted at prices that may have been below where we're at currently. So I think if I was importing corn into China, I would want to get that corn there.
Great point.
At those prices.
Plus, there's a policy incentive probably to not have massive cancellations. All right.
Next question. How are you coming up with your price forecast? And I think this has to do with the soybean projection with the same ending stocks, but of 50-cent price increase on your side, 1040 or 1090 compared to 1040 from USDA?
That's basically looking at where spot prices have been. We have been over $11 for some time here in the Eastern Corn Belt. And again, the USDA Farm Price Receive Series is a complicated animal because it's based on marketing weights by month. And we know those are bunched somewhat in fall and January delivery, and they're impacted by forward sales. So the connection is not always clean. So it basically comes down to how much forward sales are implicit in the USDA's 1040. But based on the behavior of spot prices, I expect their forecast for the marketing year to inch upwards. Maybe I'm a little aggressive at 1090, but we've been, it looks like we're going to see an extended time of spot prices above $11. So I think that's how I did it.
Let's stay with the forecast, but go to usage. And I don't know, Scott, whether it'll be you or Joe that wants to answer this, maybe both. Do you see, and this is for soybeans, new renewable diesel plants impacting the soybean balance sheet at all? Some of the new facilities ramping up in 2021 from Marathon, Phillips 66, CVR Energy appeared to be using predominantly soybean oil to start with. And I did talk about this last week on the radio during my shows too.
Right. This is a very interesting situation. There's been definitely an increase in building of renewable diesel plants, largely to feed into California at this point, somewhat in anticipation of maybe more states going into a California carbon standard, and the future in biofuels. That the bet is clearly on renewable diesel. I want to see those plants actually come online, and I actually want to see what their feedstock streams are before I would bump up for 2021, 22 the usage on soybean oil a lot. That should already be factored somewhat into the USDA forecasts that are implicit in what I was showing as well. But it's certainly something to keep an eye on. We don't want to make the mistake that I personally made in 2005, 2006 of not paying close enough attention to all those ethanol plants as they were being built. So this is definitely one of my winter homework projects, is to really get on top of the renewable diesel building mini boom and what its implications for soybean oil might be. So now I would say just cautiously optimistic. If we're wrong, I don't think it's going to be by a huge amount right now. So I don't know if you have anything else.
No, not on biofuels, Scott.
Okay.
Well, we'll stay with biofuels for just a second since we're there. What legislative decisions are coming up that may impact the current RFS, ethanol blend requirements, if any? And how long do these legislative actions generally last? Or are they going to be?
How much time do we have, Todd?
Well, you said we could go as long as we wanted, as long as questions were coming in. We can watch and see how many.
That is a big one. That is a really big one. I'll give the short answer that I've been giving to others recently. I'm just going to be a little bit blunt. I expect negative news in some way, shape, or form on biofuels and RFS to happen between now and January 20th. I'm not exactly sure how it's going to happen. Probably on some SRE announcements, maybe even an approval of the petitions for a general waiver authority cuts to the 2020 rulemakings. I don't know, but I expect from the ag and biofuel sides, expect bad news sometime before the January inauguration. That's the bad news. The good news is I expect the Biden administration to be much more of a return to the pre-2016 status quo on implementation of the RFS. I think the Biden administration will follow the court rulings on SREs. And so in political terms, crude oil refiners were in the driver's seat at the EPA under the Trump administration. That's not a controversial statement to make. It's pretty clear they're not going to be in a Biden administration. And I think that's good news for RFS implementation going forward. I think that there's almost zero probability of the RFS being changed. There'll be a lot of headlines, bills introduced about climate policy and so on. I don't expect any of it to actually change the RFS. I think we're going to go back to the glory days of what I'm known for. The Grassley rule is going to be alive and well in the next 4 years, preserving the RFS as it is. There, that's my spiel. That's my story, and I'm sticking to it, Todd.
That's a good story. I like the Grassley rule. Joe, those Chinese corn consumption numbers look really stable given all the disruption in their livestock market, ASF, of course. Do we have any more visibility on Chinese corn consumption and what its outlook might be?
I wish we did, is the short answer. No, we don't. And I would completely agree with the sense that, yeah, that Chinese corn consumption number looks really smooth. But I think that the one place where we get some certainty is on actual export numbers. And that kind of tells us something about that gap between domestic consumption and production. So I don't like to, if there's one number in that balance sheet that you can sort of hang your hat on, it's got to be the import number, because the customs data is at least, I think, something tangible that you can really put your hands on and sink your teeth into. So I would say, obviously, that gap has been growing, and it certainly seems possible that I think part of meeting that gap has got to be domestic production in China. It doesn't seem likely that the consumption numbers are just going to go through the roof now when maybe they hadn't in the last 2 years. Yeah, maybe those numbers are a little smoothed, but I don't see anything that sort of makes me think they're biased strongly in one way or another.
Couple of quick questions to answer. Somebody wants to know whether there are CCA credits available for this. To the best of my knowledge, and Scott, you can confirm this, there are not. That's correct, right?
That's
no
correct.
CCA credits, correct. And then there was a question about weather. Does our Nino weather index or pattern historically match that of South America? In other words, they want to know, are we in for a dry 2021 growing season, much like South America is experiencing now? I talk to Eric Snodgrass every Friday on the radio station, so I asked him this question that I was pretty sure of the answer. He says, nope, the La Nina that developed this fall and will last for the winter will likely fade through early spring. The correlation with our summer weather pattern is about 0.3. El Ninos are typically wetter and cooler during our growing season, while La Ninas tend to be drier and warmer. So the correlation is just 0.3 on that one.
Let me add on that. My personal skepticism on all of the SST correlations. I've looked, there's always a lot of chatter in the markets about these, but if you look at the data, maybe there's a small impact on particular patterns of El Nino or La Nina in South America or North American growing seasons, but it's really surprisingly small. I just put me on the skeptical side, and that I don't want to put my money on those relationships.
I will flip on the other side. The South American weather especially can be really dry depending on what's happening. I think with the La Ninas, and that comes just from talking to the weather guys. So we have a difference.
I don't agree with the weather guys. I've looked at the data and
yeah,
I
so
don't see it.
But yeah,
I don't know what they're seeing. I can't find it in the data. I don't know, Joe, if you've looked at that or not. But
Can't say that I have, and maybe for that.
So anyway, that's what I've looked at in some FarmDoc Daily articles. So next question.
All right. Do your yield estimates assume average weather or something else? And I think this probably goes to the difference between your average yield. I think University of Illinois yields are for corn are what, a bushel and a half or 2 bushels lower generally than what USDA comes up with?
Right. These are just standard linear trend regression based estimates. And, Todd Hubbs and I did, if you're interested, a series of, I think, pretty interesting FarmDoc Daily articles on all the issues related to trend yield estimation in corn and soybeans last summer. And technically speaking, you don't assume average weather, but the way people usually think about it, that's approximately what we're doing. You're saying basically a trend yield says, okay, what yield would you expect when you average across all possible weather outcomes? Okay, you technically aren't, when you say average weather, you're saying, well, what if we got average weather in May, average weather in July, average in June, July, and August, and September, and so on? And then what yield would you get? You would actually, if that pattern actually happened, you would get higher than trend yields. And I'll leave it at that, Todd, given our hour.
Here's a question we get asked all the time. How does currency exchange affect prices between China and the U.S.? And Brazil? It's a little more defined than what we normally get. But is there much of an impact?
Go ahead. I'll let you have that, Joe.
Oh, gosh. So yes, there is an impact. And we saw that with Brazil. Brazil exports because their currency is so weak, and so it made Brazilian commodities very cheap. So yes, it has an impact, but it's going to be complicated because now you're talking about a sort of three-way relationship between 3 different currencies. And so I'm not sort of projecting anything about currencies into when I'm sort of thinking about future trade. It's really about production and consumption issues. With the currency stuff, the currency stuff really comes into play when we have sort of some short-run dislocation, right? That we thought, Brazilian producers thought the currency rate, exchange rate was going to be X, and now it's something else, and that changes their willingness to supply commodities into the internet. If all those things stay where they are, I think then really it's more about production and consumption issues driving driving the bus. In terms
Well,
of
on that
what-
note, Joe, you showed the Chinese domestic corn price at about $10 a bushel versus an imported price of $6. What is the price that domestic pork producers face there? And do government policies influence the actual price they face, resulting in domestic pork consumer price versus U.S. imported pork prices?
Yeah, my understanding, and again, my understanding of pork production in China is relatively limited. But my understanding is, yeah, they're facing this domestic price, which is what generates the impetus to import corn from abroad. Is that the corn that exists in China, to get it and use it, is very, very expensive. How that sort of balancing act plays out between, for corn users choosing to use domestic versus imported supplies, I don't really have a great handle on. I think once you sort of get inside the borders of China, I think sort of a different set of rules potentially applies. And that's a very hard thing to get a handle on.
I think we've answered this in part, Scott, but maybe you could go a
Okay.
little bit more in depth. Do you anticipate major changes in trade policy from the Biden administration, particularly regarding its approach to China, or shall we leave that one for Jonathan Coppice and company a bit later in our webinar series?
I take a quick. I think, in short, that we will see a return to more of a multilateral, traditional trade stance vis-a-vis China. But at the same time, I don't think we're going to see a complete reversal of, if you will, more of a competitive, hostile stance toward China, even out of the Biden administration. If that makes sense, that's where I'm coming out. Joe, I don't know.
Yeah, I would agree that there are sort of things that have been done that can't be undone. And there are real issues in terms of sort of competition, foreign investment in China, issues that the United States has with how the Chinese government does this, that we all want resolved if we're sort of thinking about putting ourselves in the shoes of the US government. But yes, more multilateralism, and hopefully that creates, maybe changes sort of the pressures that exist in terms of trade policy, and puts U.S. ag in a better position to take advantage of. In fact, we have a comparative advantage in producing these ag commodities. They should be going around the world, and hopefully that continues.
Scott, have you been going through some of the remaining questions? We're over the top of the hour and didn't know whether you had something you might want to pick up and answer directly. If not, I'll pick one of them and
You go ahead.
continue on. So with such a bullish market forecast, can these factors be offset by the money funds taking gains? And I've got follow-ups from this too, I saw for sure, and I may have deleted it by accident. But if you could talk about the longer term trends and where we go from here, and this would have to do with the new plateau and such.
Excellent. Well, I'm definitely on record as not agreeing with the argument that the money flows have anything but a marginal small impact in the short run. Supply and demand fundamentals set the prices for any horizon, for grain and oilseed prices for any horizon beyond a few hours to a few days. And even over those very short intervals, it's arguable how much influence the fund money flows. Everybody in the market loves to talk about that stuff, but if you go and actually take it to the data, it's hard to find relationships. The larger question is, what does this mean in terms of where are we heading in price levels? Basically, the way I see what we're going through now is, I would call it a mini boom. And it's not likely to alter the long run trajectory of corn and soybean average prices for a 10-year period. So I think we're, it's now pretty clear that we're going to be, we were kind of in a 330 to 360 US average price environment from 2014 through 2020. And I think we're now going to look at the next, depending on weather around the world, probably 12 to 18 months well above that. But we will see supply response, acreage will expand, we'll eventually get good weather. And I don't see anything that would say that we won't probably kind of sometime in the next 12 to 24 months, we'll begin moving back towards that kind of 350 corn, 875 beans long run average. I don't see this, what we're going through yet, as a game changer.
Anything to add, Joe?
No, I think Scott's, I mean, on the managed money question, I would agree completely that often if you look at the data, like these big money flows tend to follow the market as much as they lead it. So don't sort of if you're basing everything on that, I think there's a lot of other stuff going on that you're missing. But I think on the rest of it, the supply will respond when the market gets tight. And I think Scott's acreage projections are a big indicator of that, or show that very clearly. And when that happens, especially if we get good weather, the potential for a move to lower prices than what we're seeing right now is really clear.
So you show large imports of soybeans by China, but much smaller imports of corn compared to their domestic production. Is this being driven by China's relative cost of production for these crops, or perhaps differences in world prices for the respective crops?
Yeah, so it's in part a policy decision on the behalf of the Chinese government to favor grain production over soybean production. That's a conscious policy choice. And that is actually a sort of a big outstanding question on the yield growth in China. Carl Zuloff has a great article on FarmDoc Daily about China's grain sector and how do they sort of continue, how do they grow corn production? And one way to potentially do that is actually to plant more soybeans to take advantage of crop rotation in a way that maybe they're not right now. That's pretty speculative because you have sort of different weather, regional issue, different sort of supply production conditions in China than you do in other parts of the world. But conceivably, there are ways that China may be able to increase corn yields, and soybeans may be part of the answer there. But the larger story is that Chinese government policy has favored grain production and really had a goal of self-sufficiency in grains as opposed to oilseeds.
Following up on that, China acquired Syngenta. Do you see higher China yields at some point soon from the use of GMO seeds? And it's not only that China acquired Syngenta, but Bayer, Monsanto, and of course, I want to say Pioneer, but I'm not coming up with the right.
DuPont?
Oh no, it's a different name at this point. They spun it off, and I can't come up with it. Are all active and have been for 10 or 15 years now. Will that have an impact, or much of an impact, do you suppose, in bringing up their yields? I know when you look,
yeah,
it appears it has.
I have no sort of special insight on this, but I mean, there's been very limited planting of GM corn and soybeans in China up until this point, almost none. And on the other side, there's still a tremendous amount of skepticism about GM crop consumption on behalf of Chinese consumers. That could be the thing that finally gets those yield projections moving onto a significantly higher plane than they have been, because yield growth in China is about half of what it is in the United States. And I don't think that GM has been a big part of that story now, but I have to think that it will be part of the story in the future.
Thank you, Roy. It's Corteva.
Yeah, I knew that.
I did too. I just could not for the life of me coming up. I think there are a couple of other questions maybe we should get answered. And I don't know whether you know the answer to these, though I think I saw it recently. Logistically, what is the maximum export capacity of all grains per month from the United States?
I do not know that, and I'm not sure. The only way you could probably get a real handle on that without private sector proprietary data is just to look in the historical data of what's the maximum grain export volume that we've ever done. And I don't have that figure off the top of my head. I don't know if Joe does or not.
That would seem to be a great, like, very quick way of doing it. I mean, it's really difficult to know at any one given point in time, right? Where is the bottleneck in the US grain handling and transportation system that would limit you from exporting more corn, soybeans, wheat, whatever? In part, it's going to depend on where those commodities are going, right? So if it's China, then it's, how many trains can we push out to the West Coast to get those things on a boat and move them to China? And my sense is that we're not sort of close to that. We haven't sort of hit those bottlenecks. If you look back, this would have been 6 or 7 years ago when we had a very difficult time moving commodities to the West Coast. There were a bunch of issues with rail transportation. The Canadians had this issue much more acutely than we did in the United States. There can be these sort of periodic bottlenecks, but to think that there's sort of a maximum number at any, that's going to change all the time.
And I think maybe one final question, unless you guys
Okay.
have more that you want to pick apart here. How will higher prices affect foreign acreage in production? Is there a lot of free acreage globally that can come in and out of service?
That answer is yes. There is a large acreage base that can come in, but the evidence is that in over a 1 or 2 year horizon, what economists call the acreage elasticities, a fancy word for how responsive the volume of acreage is to price, is really low. So the base doesn't increase. So, a 3-month rise in prices is probably not going to move the size of the global acreage pie a lot. Now, what will more happen will be shifting the allocation among crops. That can be very large globally. And you can also increase the intensity of input use in response to higher profits as well. And those are the two responses that you'll see in the short run, I believe, not so much that will draw in. There's kind of an ongoing trend of acreage expansion in Brazil, and it will probably continue regardless. It'll be largely the same with or without these incentives. Probably a little bit higher. USDA has got a pretty aggressive forecast of, for example, Brazilian soybean acreage going up almost 5% this year. That means they're probably tearing up some pastures down there. But from a global perspective, that's the way I see it.
I said final, but I do have one other question. Belton Road.
I 12:30, Todd.
I was looking through the questions again, and this isn't quite what they asked, but it is the question. The Chinese Belt and Road policy. Brazil, Africa, I think New Zealand, maybe even Australia. What impact does it have over time as the Chinese try to reconfigure their supply chains to shorten them up?
I guess very hard to say. It will make a difference, and probably where you think it might make the biggest difference is in Central Asia, where there is so in Russia, Kazakhstan, and that part of the world, there's a lot of investment in rail capacity and things like that that could, combined with a whole bunch of other stuff, make a big difference in terms of ag supply and demand balance for the commodities that we produce here in the United States and competing commodities. But I think a lot of other sort of pieces have to fall into place too.
No, I think that's a great answer, because I think what it says is that, in terms of China, you probably, on soybeans in particular, you want to keep your eye on the Ukraine, Russia, India. They're clearly going to make long-term investments to try to diversify away from both the U.S. and Brazil, and so we are going to have heavy competition there.
Scott and Joe, thank you for
Uh,
joining us today. We appreciate that.
Thank you, Todd. You always do a great job, and hopefully we'll see people in person next year.
Yeah, so I did make a quick mistake. Yes, in person. Yeah, next year. That would be fantastic in 2021. I did make a quick mistake because I was reading through the slides. It is Tuesday, December the 8th. So those are the next two that are up when I was discussing the Illinois Farm Economic Summits. This, of course, is the first in 5 that we will have. If you have registered for this one, you're already registered for the rest of them. If you've not, you can go to farmdocdaily.illinois.edu for those of you watching this after the fact and get yourself registered as long as it's before the 15th day of December. Our thanks to Scott Irwin and Joe Jansen, agricultural economist here on the Urbana-Champaign campus of the University of Illinois. And behind the scenes, Jim Bolts has been running the operation and making sure everything goes well on your end. And what you see, we thank him as well. You have a great day. I'm University of Illinois Extension's Todd Gleason.